Hello and welcome. My name is Matt Shear with PMA Practice Transitions, and I assist dental professionals in selling and buying practices in the state of Ohio and Western PA. And my colleague is.
I'm Joe Gordon, and I do the same in Indiana and Northern Kentucky.
And today we're going to talk about what's in your dental loan.
That is
Understanding the terms of the loan and what everything means, I guess. And there's really two types of lenders that we consider, right? There's your dental lenders, your banks that lend on a consistent basis to dentists, and then your local banks,
right.
essentially.
And in doing transitions for the years I was in public accounting, what always worried me most when I was selling a practice is I would always ask the buyer where they're getting their financing.
Absolutely.
And if it's, the First National Bank of the town that has one railroad track through it, I would immediately get worried because I knew I was going to have to explain everything to the banker because he probably has never financed a dental practice in his life, and certainly is probably more akin to financing a farm or a combine than he is a dental practice.
Right.
That's why people existed like Matt, who spent years in dental specific lending.
So let's break down the loan, I guess, a little bit, and what the terms mean. And you really need to look at this information when you're applying or getting a dental loan. There's something called the term. It's the length of time that your loan is in play, right? Fair enough?
Yeah.
And then there's what's called amortization, and that amortization is really a length of time that sets the payment or the amount of the payment. So you can have, the longer the amortization, the lower the payment. So you can have a 10-year amortization loan with a 5-year term. Mm-hmm. And what that means is the amortization is setting the payment based on 10 years, but in 5 years, you have two choices. Once that loan is up, you can pay the difference that's owed on the loan or refinance what's left on the loan for another term. So you have to really be careful because a lot of times banks will amortize a loan and give you a shorter term, which means if in 5 years when that loan comes due and the practice isn't maybe going as well or as you thought it would financially, or things just aren't right in the banking world and you've got to refinance that loan or pay it off, you could be in some real trouble.
You can be, and if interest rates climb on you during that period of time, that may spell some trouble when you go to refinance that loan.
Yeah,
that'll be a large factor. Now, we don't just go out and get a loan from a bank, Matt, just for the practice itself. What are some of the other things that are contained within that loan?
Well, a lot of times banks will give you either working capital or a line of credit. So some call it operating capital. The difference between operating capital and a line of credit is typically operating capital, there's a set amount and it's funded with the loan. So it's in the loan terms, whether it's a 10-year amortization and a 10-year term, and it's paid back over that time period. Whereas a line of credit is just that. Think of it as like a credit card, right? If you don't use your credit card, you don't owe anything on it. You might have a limit of $10,000 on your line of credit. Well, you can use that line of credit up to the $10,000 and you pay it back. Once it's paid off, then it's done and you can reuse it again. I think the other big thing to look at is the rate versus the term. So the shorter the term, the lower the rate. So when you're comparing or trying to compare apples to apples on a loan, you got to be careful with, I've got a 10-year term and a 10-year amortization at 5%, and I've got a 10-year amortization with a 5-year term at 4%, right? Mm-hmm. The term is setting the rate. So what's the better deal? That's the thing. You can't just look at rate and say, oh, this is the better deal, so I better go with that.
Right.
And too often than not, as consumers, we're price sensitive, we're rate sensitive, all that good stuff. That's the first thing we look at and we say, oh, well, this bank's giving me 4.5% and this one's giving me 5%, so I have to go with this 4.5 because it's a better
Well,
rate.
here my bank's gonna give me a loan for my practice, and they told me I don't have to make a payment for 6 months, so I get free money for 6 months, don't I?
Oh, sure, you get free money, Joe. Little did you, little did you, but you forgot that interest is accruing during those 6 months that you're not making a payment. So,
Sounded too good to be true.
in the banking world, we call that negative amortization. So what happens is if you took a loan today for $500,000 and didn't have to make a payment for 6 months, all that interest is accruing. If you had to pay it off in 6 months, you might owe $510,000. So you're going to owe more than what you borrowed. So just be careful of that as well. Some banks offer interest-only payments, which isn't necessarily a horrible thing. They may offer you a 10-year term with a 1-year interest only. You just got to know that after that interest-only period, you're not negatively amortizing the loan, but your payments for the next 9 years are going to be a little bit higher.
Right. Quite a few things to consider. The most important is make sure you match yourself up with someone who actually lends in the dental space.
Absolutely.
And understands the nuances of dentistry and dentistry lending.
And the lowest rate isn't always the best deal.
No.
Keep that in mind.
No.
And if you want to talk to Joe or I a little bit more about financing, please don't hesitate to give us a call. We appreciate you attending today, and if you liked it, give us a thumbs up and certainly share us with your friends and colleagues.